Are you ready for the next bull market? History suggests that now is a great time to invest in the stock market. Over the past year, rampant inflation has called into question the strength of the economy, and that has triggered a sharp decline in the stock market. In fact, the broad-based S&P 500 had its worst first half since 1970, and the index crossed into bear market territory in the second quarter. The S&P 500 has since rebounded slightly. It sat 17% off its high on September 12, but the bear market is not technically over until the index surpasses its previous high. For context, the S&P 500 last peaked at 4,797 on January 3, 2022. Many investors are probably wondering how much longer the downturn will last. How long do bear markets last? The S&P 500 has fallen into correction territory 26 times in the last 5 decades, meaning the market falls 10% or more about once every 1.9 years. Bear markets are more severe market corrections. The S&P 500 has dropped into a bear market 7 times in the last 5 decades, meaning the market falls 20% or more about once every 7.1 years. For bear markets in the last 50 years, the chart below shows the start date, trough date, peak loss, and the number of days it took the S&P 500 to reach a bottom. Of course, the bear market that started earlier this year is not included because the S&P 500 may yet fall further. How can you prepare for the next bull market? The most important thing any investor can do to prepare for the next bull market is to maintain a long-term mindset. Ignore the day-to-day noise and focus instead on the big picture. The worst mistake an investor can make is trying to time market cycles. Consider the following data from JP Morgan Chase. If you had invested $10,000 in the S&P 500 at the beginning of 2002, that sum would have grown 517% to $61,685 by the end of 2021. But if you had missed the 10 best days during that time, just 10 days, that initial sum would have grown just 183% to $28,260 by the end of 2021. And guess what? 6 of the 10 best days during that time period actually occurred during a bear market, and 2 of the remaining 4 days actually took place on the day following a bear market's bottom. In other words, the stock market's best days often take place during a bear market, and missing just a few of those days can do tremendous damage to your portfolio. That means the best way to prepare for a bull market is to stay invested through any downturn. Better yet, investors should continue to buy high-quality stocks on a regular basis. Something big just happened. When our award-winning analyst team has an investing tip, it can pay to listen. After all, the newsletter they have run for over a decade, Motley Fool Stock Advisor, has tripled the market. Asterisk. They just revealed what they believe are the 10 best buys for investors right now. And while timing isn't everything, the history of their stock pick shows that it pays to get in early on their best ideas. Up to now, Bitcoin, dragging the altcoin rabble in its wake as always, has been following more or less the same ups and downs it has traced out in past cycles and which mark the typical shifts in psychology that drive bullish and bearish periods. In fact, occasional claims that this time is different are themselves to be expected as part of the pattern, demonstrating that this time is, as things stand, the same. This is not to say that external factors, monetary or political, are the same as before. You can't stand in the same river twice. But those external currents are carrying Bitcoin and crypto around familiar channels and are balanced, perhaps, by the knowable behavioral shifts that provide energy to markets. Essentially, there was a free-for-all, and valuations bubbled through the roof. Not all of this was simply optimistic recklessness, though. In fact, it made sense to take advantage of what was occurring, and if a purported quality of Bitcoin is that it can be used to hedge against currency debasement and inflation, then it worked, soaring in price when cash was cheap. Bitcoin's subsequent crash is not evidence that doesn't function as a hedge, but rather that it reacts rapidly, but coherently to changes in the wider monetary environment, including both relaxation and tightening. Speculation around NFTs and, later in 2021, metaverse development were also drivers of interest. Ethereum in particular, positioned to be the foundation upon which Web3 and the metaverse will be built. At at times appeared to be running on its own distinct narrative, partly uncoupled from Bitcoin's dominance. At last, thanks for watching our video.